how much of the moves we've seen over the last week are really about the increased chances of Donald Trump getting a second term in the White House, and how much of them aren't? And on an afternoon like this afternoon, does that really change anything at all for financial markets worldwide?
Yeah, we think a big part of the market movements over the last week really didn't have too much to do with the politics. If you think about that small cap trade, it was really a function of weaker inflation data coming in a week and a half ago, causing yields to plunge and bets that the Fed would start cutting rates to rise significantly. That sparks a huge short covering rally. The narrative goes along with it that maybe Trump is more beneficial to small cap stocks. Of course, there's also the narrative around a risk on trade that benefits small cap stocks. So certainly there's a lot of things that markets are doing as they do, and not necessarily because of what's going on in Washington.
Also, Washington is in limbo. Cameron, is it potential that markets are just waiting until they get the final ruling on who is going to be this Democratic ticket to see potentially what kind of policies we could see coming out of a Kamala Harris and VP unknown yet ticket?
It certainly seems that way, at least in the futures today. They're taking it in stride. And if you look at the betting odds for Trump, they only went down slightly by about 3 points. And it was effectively a 1-for-1 exchange between Biden and Harris, just meaning that the market doesn't seem to be interpreting Harris as a very strong candidate that could challenge Trump. And that actually is perfectly reflected in her approval rating, which is effectively equal to her betting odds at just 38%. So until we get clarity that this is the actual choice, and potentially there's a chance for Harris to resurface her image, that could be something that could cause her odds to go up. If we've learned anything over the last 3 weeks, it's that things can change very quickly, and we shouldn't count on status quo, though.
Yeah, you can say that again, Cameron. It has been an unbelievable few weeks in American politics. It's worth reminding everyone that at this time last week, we were all still assessing the aftermath of an attempted assassination on the former president and Republican nominee, Donald Trump. Of course, to your point, though, all of this political news comes against a backdrop of other macroeconomic forces at work, including questions around monetary policy. Now, I heard from a number of Republicans in Milwaukee suggesting that while the Fed is independent, moving before the election could be seen as political, especially if the political uncertainty is heightened. If we all of a sudden have this new race, a newly instilled Democratic nominee in August, is the Fed going to be less likely to cut in September, given all of the other elements that even if they say they can't consider it, we all know they don't exist in a vacuum?
Yeah, we hope that it wouldn't impact it too much. If you look at what the bond market is pricing in, though, it's 100% certainty of a cut beginning in September. So there certainly would be room for that probability to come down, which is why people will be parsing Powell's words in the July meeting very closely, as people think that that is the setup for them to start cutting in September. Of course, we also get Jackson Hole in August, but that tends to be a little bit more of a long-term policy outlook. Overall, the market is now pricing in about 2.5 cuts for the total year. We think it's actually far more interesting, though, what goes on in 2025. 1 to 3 cuts is very consistent with a non-recessionary cutting cycle. Do we get the full 9 cuts that's priced in between 25 and 26? That is likely highly dependent on the kind of policies that we get out of D.C.
Of course, we're not likely to see much policymaking between now and the election. The lame duck session could be entirely different, Cameron, but Joe Biden has effectively made himself a lame duck already with this decision. Knowing we have seen rhetoric coming out of Republicans today, the suggestion that if he's not fit to seek re-election, perhaps he isn't fit to serve as president of the United States, especially when we consider the way the world may be looking at it. At this situation, do you think this heightens geopolitical risk, whether it be activity in the Middle East or with Russia or China? And should that be something that is therefore hedged to a larger degree?
Yeah, that certainly is always a fear that seems to be on people's minds and points of weakness during times of politics, meaning that there's this strike while the iron is hot kind of mentality. We'd certainly hope not. That is, of course, something that we always consider as a potential risk to markets is heightened geopolitical uncertainty. But as we've seen, we've been in an incredibly geopolitically uncertain environment for the last 2 years, and yet markets keep on chugging along. So a source of volatility, not necessarily a source of direction for the markets.
If the market was going to reflect that uneasiness, though, would that be in the oil market? And I'm looking at that because Benjamin Netanyahu is set to arrive in the United States this week. And there's been all this talk about some potential peace treaty when it comes to Gaza or negotiation, get the hostages out, calm the waters. That doesn't look possible, to Kayleigh's point, with a lame duck president.
Yeah, we haven't really seen that much of a geopolitical risk premia, though, priced into oil markets, given the fact that oil prices aren't significantly higher since tensions in the Middle East really did flare up. The thing that's actually, we think, more interesting for oil prices would potentially be dollar policy. You've heard Trump and Vance talk about a weaker dollar being something that they would like and welcome. Typically, a weaker dollar is associated with stronger commodity prices as well as higher input prices, which could be an interesting wrinkle in the progression of inflation as we move into 25, if they are in fact able to unilaterally push for a weaker dollar.
Cameron, for a number of years, in fact, for the best part of a decade, we've talked about US exceptionalism. You and I have had that conversation many times before on Bloomberg programming. Cameron, I just wonder if this political instability in this country, not just this year, not just the last few weekends, over the last several years, undermines any of that trade whatsoever.
So we see political instability weigh on the sentiment surveys. You can see it in things like University of Michigan surveys, which break it between Democrat and Republican. But as all surveys have been over the last few years, it's watch what they do, not what they say. People might say that political uncertainty is weighing on their desire to do certain things, but you still see relatively resilient capex. You still see relatively resilient consumer spending, which just means that markets and consumers and businesses chug along, find a way to be great regardless of the uncertainty and the disruptions going on in Washington.